So first and foremost, thank you everyone for registering and taking some time to attend the webinar this evening. Really appreciate it on a Monday evening at 5 p.m. Eastern. If you're on the West Coast, it's midday. A huge thank you because you could be at work or had to rearrange your schedule. So we are going to discuss a very popular topic today, which has to do with cash value life insurance and real estate investing. When it comes to real estate investing, this is one of the most popular topics with everyone we work with, and really for the years that I've been in business and specifically focusing on cash value life insurance policies set up for maximum flexibility and such. We often talk about how to optimize the internal rate of return, but the next step is how do I use the policy? How do I actually put it into action? Because I don't want to just park the money and let it sit and grow. Some people do, but many want to actively use their money. And the number one item, just if we were to pool everyone we've ever worked with, is this: real estate. Now, if you're brand new to this, or someone said, hey, a great way to invest in real estate, Steve, is with a whole life insurance policy. Most people would hear that, and if I'm new to all of this, I would hear that and say, what are you, nuts? Like, what are you talking about, life insurance? Well, it has to do with the cash value, which, as usual, we are going to go into a deep dive, answer a lot of very specific questions throughout this evening's event. So let's have some fun, shall we? And again, if you have questions, please use the Q&A box. So it is an interesting concept, the concept of using a cash value life insurance policy for your real estate investments or real estate practice. Now, some move forward on concept alone, meaning we've seen a lot of people move forward and take out a whole life insurance policy, use it for real estate investing because they've seen other people use it. Have you ever done that with anything aside from cash value life insurance? But then many, including myself, prefer to look at the numbers first. Like, the concept intrigues me, but it has to actually work, and I want to see the advantages. I also want to see the disadvantages. Where do people get upset? We're going to hit on the sour items as we go through everything tonight too. So we've got this idea or this concept here of the family office, which I'm not going to go into full detail this evening, but the concept of the family office and looking at the numbers is so important. The reason why is it involves a group review. Often, if I'm interested in a product and I'm working with a salesperson, let me know if you've ever done this. Have you ever spoke or worked with that salesperson and you really like them, they just connect with you and you buy from them because you like working with them? Well, that can happen with cash value life insurance. We get caught up in the emotion and such. We're human beings. Family office concept prevents us from making a decision on our own. We're working with a group of individuals, typically qualified individuals, that are going to vet our decision, going to look at the investment, if it's a real estate investment, whatever it might be. We've got a number of people looking at everything and then approving that decision. It allows us to remove emotion. Emotion cannot be involved in that decision-making process, whereas on our own, we might say yes, and then the group looks at it and says no. So can we do the same thing on our own without a big group of professionals? We can, but it involves no emotion. We want to look at the numbers here. So what we're going to aim to cover this evening: building awareness, providing transparency, and then avoiding buyer's remorse. You ever feel like this? I didn't know that situation? This happens a lot. And with any financial vehicle, in this case, a cash value life insurance product, I do not want this to occur. I didn't know that. I would have done things differently if I did. I don't want that to occur after I've committed my money somewhere. I want that awareness. I want to know everything before I start a product. This way, I don't have buyer's remorse and I don't have a sour taste in my mouth. Ever felt like that with anything? It happens. So, points we'll cover are as follows: why some real estate investors use whole life insurance for their practice. I want to emphasize the word some. Not all do. A lot of real estate investors do use it, but it is not for everyone. Policy flexibility. As a real estate investor, your cash flow likely fluctuates over time. There are some elements that are outside of your control. Using the money, specifically how policy loans work. We're going to go through how they work from a transactional standpoint, meaning what are the specific steps when I want to take a loan out, whether I want to request it online, do it over the phone, details, how does the loan interest work. We're going to cover a lot more too. A dividend of 6% versus a loan rate of 5%. Have you ever heard that? And does it really work like that? Not so much. We'll go into detail on that. And then look at the net numbers. That bridges on the last point, point number 4. So let's begin with the why. Why do real estate investors use whole life insurance? To sum it up, accessing the cash value in a whole life insurance policy is similar to accessing equity inside of a piece of property, inside of real estate, but with the difference of having guarantees and some added conveniences. So many real estate investors that I've spoken with over the years will often acquire real estate with real estate they have. If they have equity, they'll borrow against a piece of property they have, often at a low cost to borrow, so they're leveraging an existing asset to acquire another one. Not a bad strategy at all, and it's very similar to using a cash value life insurance policy. So with a piece of property, you will continue to earn appreciation on the entire asset, and then you have a cost to borrow, in this case loan interest, only due on the outstanding loan. To illustrate this, let's pretend that you've got a piece of property. It's appreciating at 5% every single year like clockwork, no market fluctuation. Your property does nothing but go up by 5% every year. I'm saying let's pretend that this happens because we know this isn't reality. But we'll pretend this scenario. You've got a property value of $100,000, simple round number. You elect to take a loan against that property. Let's say it's a line of credit for half, $50,000. There is a cost to obtain that loan. That cost, the loan interest, will go where? Goes to the bank or lender in this case. And then you've got $50,000 in remaining equity. Now here's my question. That 5% depreciation, does that occur only on the remaining equity or on the entire property value, even though you have a loan outstanding? On your entire property value. If the fair market value of your home goes up from $100,000 to $105,000 and you sell it next year, the sale price is $105,000. That loan does not impact the appreciation. Now, how does that relate to a whole life insurance policy? Very, very similar. Let's pretend or assume that your whole life insurance policy is appreciating at the same 5%. Specifically, the cash value net growth rate is 5% in this example. So 5% appreciation in the insurance industry, the translation would be a 5% internal rate of return. Notice not a 5% dividend. Very important to be aware of that. So if you've got a cash value balance of $100,000, you elect to do the exact same thing we saw with the real estate. You take a $50,000 loan. We have a cost to borrow or interest that goes where? Not back to ourselves, not to a bank or lender, but to the insurance company in this case. And then we have remaining equity, remaining cash value of $50,000. Make sense? We're going to look at some examples with actual numbers and illustrations shortly. So, some of the main core benefits to the cash value, and this really solidifies the reason why. If you were to ask a real estate investor who really grasps the product, they dug into the numbers and they use it on a regular basis, and you ask them, why do you use whole life insurance? Like, what's the reason why? Well, when you look at the cash value, it is a safe area to position money. We've got that 3 to 5% internal rate of return. That is consistent if things are going very, very well in the economy or very, very poorly. That 3 to 5%, I can bank on that. Historically, it's done much better, but this is shooting it a bit more conservative. And when I say you can bank on that, I forgot a big if. If the policy is set up properly, and if we're using a company that has a proven track record, particularly one of the 4 major mutuals. So number 1 bullet point, as far as the why is concerned, safe area to position money. Number 2, liquid. We can access the money anytime. We get that constant compounding, like this example. We took a $50,000 loan. We continue to yield that 5% appreciation on what? The full $100,000, as if we never touched it in the first place. Keeps on compounding. And then this big one, underlined in gold here, control. Maybe this happened to you, or maybe it's happened to someone you have known. Have you ever had a real estate opportunity available? And you've got a loan agreement with a bank. You're due to close in the next 2 weeks, say it's 30 days, and you need to close in order to acquire this property. You've got everything ready. The bank delays things for reasons you can't explain to anyone. They can't even explain it as you try and listen. And that 1 month closing date is pushed out to 5 months, and the deal collapses. Took too long. It was choked. That's happened to a lot of people. And I know it can be extremely frustrating, especially if you are reliant on that bank. So having that liquidity to cash value, just like having liquidity to money in your bank account, if you have access to the cash, you're not reliant on a third party, in this case a bank. Now we can access the cash value for this opportunity while our money continues to compound. And then third, tax-free. Tax-free if we don't trigger a taxable event, such as cashing the policy out with a gain, modified endowment contract. We've touched on this several times in past webinars. So those are some of the reasons as to why people do this. What about why not? What are some of the pain points for investors? What do they want more information on before putting their money into these products to use for their real estate investments? Well, number one, loss of liquidity, particularly in the early years. When someone asks, why would I not put money into a whole life insurance policy, or why people don't do this, it's always the early years, especially the first year. Even with a minimum premium, maximum PUA policy, rich cash value, early break-even point, no matter how well we design that policy, we have a negative cash value in the first year. It's a turn off for some people, but we should be transparent about it so they can make an informed decision, not an emotional one. But that is a reason why not, which leads into the second point, lost opportunity cost. I remember speaking with an individual, this was January 1st, 2020 actually, and a big objection he had with whole life insurance. He was looking at 7 figures per year going into a policy. He mentioned this. He said, hey, why would I put my money into a policy if I take this huge hit up front, takes me 10 years to break even? He was very cash rich. He didn't need the money going into a policy, but he expressed it, which tells us that is on the minds of many people. He viewed losing money a lost opportunity cost. So this is how it's often viewed. How do we overcome that to the greatest degree possible? So those are two. And then this guy here, the thought of getting a bill. Do you like getting bills? I don't think anyone does. So let's touch on policy flexibility, because real estate investors, the cash flow can fluctuate. Depends what type of investing we're in. Maybe it's flips, rental income, whatever it might be. The word insurance. When you think the word insurance policy, is it something that you get very excited about? I do, but I'm weird. If it's not a life insurance policy, say it is a auto insurance or homeowner's insurance policy, what is that you have to pay every year or every month? It's a bill. I pay that premium, and if something bad happens, I receive an insurance benefit, the basics of how insurance works. But if I take a homeowner's insurance policy, if I take a term life insurance policy, that benefit is only paid out if something bad happens, which I don't want to happen. So I'm paying that premium to cover a risk. Now, if we take a traditional whole life insurance policy, keep in mind, I said that we put in here the word traditional. I'll refer to this as a great example of what not to do if you're interested in cash value. I'll have a very low cash value up front, which is a loss of liquidity. Meaning if I don't have access to cash value, whether it's in the first year, 10th year, whenever, that's money I do not have access for opportunities. This is often what real estate investors look at in an objection that is raised. So how do we overcome it? We're going to look at it in a second. So again, low cash value equals less money for opportunities. Solve that problem by maximizing the cash value and also maximizing the flexibility. When I say maximize the flexibility, I want to reduce or minimize as much as possible that feeling of getting a bill. How do I take an insurance policy, because it is a whole life insurance policy, and take away the idea of this boring payment, I got to pay it every month, every year, take that away and turn it into a flexible savings asset where I can commit to a minimal amount, and then at my discretion, I can just throw more money into PUAs. PUAs are I'm going to touch on that soon. I get ahead of myself. So here's something that's very common to hear from someone. I like the idea of a cash value life insurance policy. those three benefits you mentioned earlier: safe, liquid, tax-free. I can borrow that money and it can continue to compound for me. I'm interested in that. But I don't want to get a bill. I want to be able to pay $100,000 per year in, but I do not want a $100,000 bill every year. Because my cash flow fluctuates, I like to prepare for the worst case scenario. You ever feel like that? There's people we work with that can put in hundreds, if not millions of dollars into whole life insurance products, but they like to prepare for it in that manner. How do I prepare just for the absolute worst case scenario? I like looking at things in that way as well, because you never know in some respects. So if you want the ability to pay $100K per year, but you don't want to get a bill for $100K, what if you could pay just $10,000 yearly, or even break that up over 12 months, a little under $900, or that's about $830 per month, and then at your discretion, you can throw another $90,000 into the policy, but you're not required to do so. And let's say it's not $100,000, maybe it's $10,000 per year. You can commit just to the minimum $1,000, and then at your discretion, you can add the additional $9K. What if you can make it very flexible like that? Well, you can. Now, different life insurance companies have different restrictions regarding their flexibility and such, which we can always provide information on. But this is very possible where you can create a very flexible policy where it does not feel like a burden in any way, shape, or form. So, as an example, let's use the $100,000. You want the ability to pay in up to $100K per year, but you do not want to be committed to $100K per year. Your money can go toward one of two areas at the end of the day. The base premium, in red, I know it's small, right under base premium it reads committed. We are committed to the base premium, at least initially. After you've funded the policy for a couple of years, especially if it's a cash-rich policy, you can get away with not paying the premium. There's options such as a reduced paid up, which we can do after the first 7 years to eliminate it. But when we first start a policy, and if we intend to continue to dump money into PUAs, we have to pay that base premium. We are committed to that. So that's our commitment. Then we have this PUA, a PUA rider. It's not a PUA rider. PUA stands for Paid Up Additions Rider. I'll often refer to this as a cash dump-in, a fantastic method to accelerate the cash value growth on a life insurance policy. But what do we see under PUA rider? Flexible. This can be designed to be very flexible where I'm not committed to it. So the PUA component does permit me to maximize cash value, but it also allows me to maximize the flexibility because the premium piece is what I am committed to. The PUA piece, I'm not. Now, if I don't add funds into PUAs, it's going to hurt me. We're going to look at an example on that, but I can make it very, very flexible and add funds at my discretion, especially if my cash flow fluctuates over time. So, as a quick example, if I'm paying $100,000 in, if I drive my base premium as low as I can to about 10%, additional side note, that 10% minimum premium is often a minimum with your top companies, your 4 major mutuals. There are carriers out there that will allow you to go lower than that. But base premium, 10K, what's your cash value look like in the first year there? Goose egg, nothing to show for. So we talked about the why not. Why would a real estate investor not do this? What's the pain point? Whatever that premium is, if it's $10,000, $40,000, $100,000, not showing up in cash value in the first year. With most products, some you can actually get it to show up, but not in cash value initially. Buys me a death benefit. As I continue to pay premiums, it does come back to cash value. So I do see a benefit, money I can access there. The PUA piece, isn't that better? $90,000 in this example, I get between 90 to 95% right off the bat. That's money I can access. Beautiful. And it does get me some death benefit. Point I don't want to go into too much detail today is the MEC limit. So a MEC limit, a modified endowment contract, is what MEC stands for. I want to avoid that. If my policy becomes a modified endowment contract, I do have to deal with taxation issues on the cash value. So every policy has a MEC limit. If I'm paying in $100,000, I want a MEC limit of a minimum of $100K. Often, if I want to fund for a long time, we'll overinflate that. In an effective way to get the MEC limit that I want is through a term rider. But we've covered this in past webinars, and you can always reach out to us for that as well. Let's look at a demonstration of this, particularly for this case. If this is you, I want to be able to pay up to $100,000, but I don't want to get a bill for that. Maybe it's $1 million. I want to be able to pay up to $1 million, but I don't want to get a bill for that. Make it flexible, Steve. So this may look familiar if you've seen any of our content. If you haven't, this is a life insurance illustration. But anytime we have money going into a policy, what I ask is, if I am you, where is my money going? Because your money, at the end of the day, can go toward one of two areas. Just like we had on the whiteboard, the premium, which is right here, or that PUA rider, which, look at this, paid up additions rider, $90,000 and change. Now the premium is actually a little bit higher than that. I should say the minimum commitment. That's the base premium. And then down here is the term rider. And that term premium, what it did is get us additional death benefit. So our total death benefit is $3.2 million. What we did here was just add term insurance for about $1,000 in the first year to raise the death benefit, which raises the MEC limit. So now I can plow up to $100K per year total into this policy. Base premium plus term plus PUA, $100K per year. Easy to follow, right? Fun stuff. Don't worry, we'll walk through it. So as we look at this guy, here we go. 100K per year going in. Just for 10 years in this example. We could go shorter, we could go longer. 10 years is clean, easy to follow. Net cash value, here we go. What's the worst year? I pay in 100 grand, I get 83,000 right off the bat. There are products where we can get that higher, but still it's a negative hit. That right there, if it's me, or if I'm explaining what's the worst part about it, this. Next year, what happens? I pay in $100,000 again. Grows from 83 to 181. So I get almost my full 100 back, but if I was earning 0%, it would grow from 83 to 183. Grew from 83 to 181. So I got my $100,000 payment back minus $2,000. I like pointing this stuff out because what are the drawbacks? We're going to look at a lot of the advantages, but I like awareness on this stuff. So important. Gets better each year. By year 5 in this example, we've paid in $500,000. We have a little over $500,000, 506 in this particular case. So this is a max funded policy where we are just hyper funding the policy year in and year out for 10 years. But what does it look like if I plan to put in $100,000 per year, but I don't do it? We're on the second bullet point, the flexible funding here. So let's take a look. Here we go. Look at this spreadsheet, a lot to follow, right? I'm gonna walk it through one at a time. It looks a lot more complex than it is. This is the exact illustration we looked at. In fact, the example on the far right matches up. There's the 506 by year 5, where you've paid in a total of $500,000. What these different columns represent, think of it this way. You're taking out a policy, you're interested in maximizing the cash value, and then potentially using it for real estate. You are not interested in the idea of getting a $100,000 bill, but you are interested in the idea of putting $100,000 per year into the policy. See where I'm going here? So here's the minimum premium plus the term rider, just about 10K. What I did here in this example was just round things up a little bit and solve for $1,000 per month going in, $12,000 per year total. So we've got the minimum premium, a little bit going toward PUAs, $2,000 in this particular example. So this is a policy where I can pay up to $100K per year, but I don't pay $100K per year. I just pay $12,000 per year every single year. A lot like a basic life insurance policy where I'm paying everything into premium. So first year, 12 in, about $2,000 in cash value. If I look at year 10, I've paid in a total of $120,000. I've got $97,000 in cash value. Break-even point in this example, long time, year 16 when he's 55 years old. When I'm only paying the base premium and focusing on the cash value performance, and what does this look like over time, it drags. Death benefit, we cut the term rider after year 10 in this example, that's why we see the drop, but still, it's not that attractive when I look at it. Now, from a flexibility standpoint, it is attractive because what this individual is doing is committing only to $12K per year, and then at his discretion, he wants to add up to $100,000 per year. So as we progress on to the next example, same policy. You can tell the death benefit, 3.2, everything's exactly the same. It's that illustration we just looked at. Here, same 10K minimum, but what does it look like if I plan to get 100K in, but I only get 50? I bid off more than I can chew. Sometimes this happens. What do things look like? If I could go back in time and rewind the clock, start with 50, I would, but show me a conservative example, which is always good to look at. So here, he's committing to his minimum of 10, 40 additional going in each year for a total of 50. So he's got room to throw another 50 in. First year cash value is what? $37,000 and change. Years pass. What's highlighted in yellow represents his break-even point. Year 6 in this particular example. I've paid in a total of $300,000, and I have $300,000. What I ran in this example, just to keep things consistent, is funding it for 20 years. Why I did that? It gets a total of $1 million in. It doesn't have to fund it that long, but a total of $1 million in compared to the example on the far right, which is just max funding it each year. 100K per year for 10 years, breaking even between 4 and 5. This is optimal. There you go. There's your time value of money. Big difference there. Just getting money in faster. I'm close to 2.1, whereas here I'm almost 5.6. Right, so about a $500,000 difference there. But what's nice about these kind of models is it displays what a policy looks like before I put things into action. What I always like to look at is when someone's interested in a policy, if it's for real estate or for anything really, and they intend to take loans against it, is the idea of leveraging a policy for loans, whether it's direct policy loans or collateral loans, is great. I love it. But the most important thing to do is first and foremost, see how to maximize the cash value. How do I maximize that growth? Because where buyer's remorse comes up is not when one's using the policy, it's when they found out they could have had more money than what they actually have if that design was different. If the company, if more companies were considered. That's typically the key objection to the number one thing that pops up, so we like to address it. So let's progress on to some loan flexibility. So the purpose of this section was just going over policy flexibility. Do you have to commit to a huge amount? No, I can commit to a low amount and add more funds at discretion. Company selection is important. Our last webinar, we covered that as far as going through different companies, flexibility features and such. Using the money, policy loans at work. How do these work? A lot of questions come up with policy loans. So let's hit on some transactional bullet points first. You can request loans anytime. When you think of the word loan, what typically comes to mind? Payments and interest. I have to get approved. Underwriting. It's a pain. No one wants to deal with it. It goes against my credit report. None of that happens with a life insurance policy. It is considered a loan, really. So when I take loans against it, they are income tax free, provided the policy is not a MEC. If it is a MEC, loans are taxable with respect to the gains only. But loans, I do not have to deal with any type of income tax here, or any tax, again, considering it's not a MEC or I don't lapse the policy. But I can request them anytime. I do not need to be approved for it. I can request them through my agent or my online portal, depending on the company. Online portals are nice. I will say this. Most people that work with us, a lot of people will use their portals, but a lot of people will reach directly out to our office. And the reason why is often, if we use the online portal, we will request that a loan is sent to our bank account direct deposit. And many times it is. But it's always that occasion where I need the money fast. Everything's set up perfectly. I hit the button to have the loan send, supposed to get there in 3 to 5 days. The company, for some system error reason, decides to mail you a check. You're on vacation. You're stressed out because the money didn't hit your account, or maybe you're not on vacation, you're traveling. My point here is there are errors that pop up. If someone's reaching directly out to us, our company is equipped to handle this. What we do is provide the loan paperwork with whatever insurance company you selected that you decided on, and then we submit that loan paperwork directly to our contacts at the particular insurance company that you have your policy with, and that we have found through experience, it's really a sure bet that everything is sent via direct deposit. And if there's an error on the form, we get notified right away, can come back to you, work with you to promptly resolve it, and then properly submit everything. So again, the funds get there on time, because it is frustrating when things are supposed to go smooth and then they don't. I think everyone's been there, not just with cash value life insurance. How much can you borrow? Depends on the company, but typically the averages are between 90 and 95% of whatever you have in cash value. As an example, if you've got $100,000 in cash value, you might see maximum available loan, $95,000. Some are higher, right? Sometimes it is just about 100%, or we've seen 99.7%. Depends on the company, term rider, loan interest rate. There's a couple factors, but just if I'm going to shoot it conservative, whatever I have in cash value, 90 to 95%. If I can borrow more, I love it. If I tell you 98%, you can only get 90%, that's typically where you don't like me very much. So we like to set things, or set expectations conservatively. So access the money anytime, including the first policy year. This has always been a topic of confusion or debate. Can you access policy loans in the first year? The answer is yes, in most cases. There are some cases, for example, with survivorship policies, at least pre-7702, before the recent industry change, taking loans against survivorship policies were permitted, but not until after the first policy year. That is one thing insurance companies preferred. I have to read up on survivorship policies with different companies to see if that's still in force. But what we always like to do with any life insurance company and product for that matter, because a survivorship policy is a product with different companies, Mass Mutual, for an example, may allow me to borrow against a basic whole life insurance policy in day one, or after 10 business days, I should say, with any policy, except for a survivorship policy, which they want me to wait 1 year. So there is a product issue there that I have to be aware of, read up on the memos, and then properly communicate that information to you if you're the one that's taking out a policy with us. But generally, you can take policy loans out in the first year. The only thing to be aware of is often companies want a 10 business day wait time. So if you make a payment, whether it's a PUA payment, loan repayment, if I send money from my bank account to the insurance company, to my policy, what we have seen is some companies like to wait 10 business days before I can turn around and request a loan. Really what they're making sure of is that everything clears the bank account, there's no bad payments, bounce backs, and they have to chase people down for their money. That's what they're looking at. Loans are typically sent via direct deposit or check, and it's similar to a line of credit. How it's similar to a line of credit is it's not similar to a fixed loan. A question we get sometimes is, if I take multiple loans, do I have multiple loan balances on my account where I have to pay each one back in its own fashion? The answer is no. More like a line of credit, where if I have $100,000 outstanding in a loan and I draw another $50,000, then I'll see my loan balance go from 100 to 150, and the interest is now due on that 150. So it's similar to a line of credit in that respect. Loan interest. So how it accrues. Terminology. It accrues. It accrues daily at annual simple interest. Know what that means? Accrues daily at annual simple interest. Let's take the example of a $10,000 loan with a 5% interest rate. How this would work is, if we take $10,000, what's 5% of that? $500. So $10,000 times 0.05 equals $500. With a life insurance policy, because you will see in the terminology that it accrues daily at annual simple interest. Annual simple interest represents the fact that the interest does accrue at simple interest, but only over the course of 1 year, annually. So to break this down, what we would do is take that $500 at 5% to $10,000, that's the total loan interest, divide it by 365 days, and that is the daily loan interest we'd see here. Keep hitting the wrong button here. There we go. So call it $1.37 per day is the interest that'll accrue. And at the end of 365 days, if we've paid nothing, our loan balance will be $10,500. Now, if you elected to pay that off in 6 months, what would happen? Well, let's take that, multiply it by, what would that be, 100, let me just do it this way, times 30 times 6, just about $250 over 6 months. Take the 500, cut it in half is what I was going for there. So if you paid it off 6 months in, your principal was $10,000 plus the accrued interest would take you to $10,250. So the full loan interest amount would only accrue over the course of a full 365 days. Now, in order to get that 365 days of loan interest, what would have to happen is you'd have to take that loan out on your policy anniversary date. So for example, if you started a policy January 1st and you take a policy loan in June, 6 months through the year, say it's $10,000 at 5%, what would happen is January of the next year, 6 months of loan interest would have accrued for a total of $250. When you are billed is on your anniversary date. Your anniversary date is when your premium is due. So just an interesting awareness point, if I have a loan outstanding, what will happen is when my anniversary date comes, I'll get the notice for my premium. I'll also get a notice for any loan interest that is due. Now often what happens here is people see that and think I have to pay it, because on the statement it typically reads, if you don't pay the loan interest, the policy is in danger of lapsing. And then there's a lot more information in the fine print. We typically don't have to worry about it. Payments are optional. If the loan interest is not paid, the policy will take a loan against itself to cover it. When you're in danger of a policy lapse is if you don't have enough cash value to cover the loan interest and you're not paying anything into premiums or PUAs to build cash value. That's where it could be in danger. It's rare. It's something we monitor with everyone we work with, but to provide awareness, we do have to be aware of that. Rates. So with new policies, this changed recently, beginning 2022 with the recent 7702 change in the industry. Rates, you will typically see variable rates range between 3 and 5% on new policies. That 3 to 5% is the floor, as low as it can go. The 3% rate, MassMutual's 10-pay product has that if you select the variable loan interest rate. That is as low as it can go. And then different products with MassMutual, using them as an example, have different minimum floors for their loan interest rates. Fixed rates on new policies, you will typically see range between 5 and 6%. On older policies, it is not uncommon at all to see loan interest rates go as high as 8%. In fact, I've got an older policy that has an 8% fixed loan interest rate. It's one of Guardian's older products. Tax benefits. If you are using your policy for real estate up there, but you're using it for real estate, which may be your business, can you deduct the loan interest on a life insurance policy? The answer is yes and no. If you're going to deduct the loan interest, the IRS rules state with respect to life insurance loan interest is that it is generally not tax deductible. If you're to look it up on the IRS website and read their language. Some CPAs and accountants that we've worked with and spoke with will state, hey, you can deduct the loan interest, or we feel that we can, because it's being used legitimately for a business purpose. Some CPAs we work with say, I just prefer to steer clear of that because the IRS generally does not like it. So if you're ever looking at that, zero tax advice whatsoever is being given here. This is just our experience in working with this, is if you're using direct policy loans, always do your best to consult with an accountant or CPA, because the IRS language does read, generally, loan interest is not tax deductible, which in my mind tells me if I'm going to attempt to deduct the loan interest of my life insurance policy, they might look at it. And not that that's a bad thing or anything, but do we like having to deal with that? Send them all information, just do everything by the book so we don't have to worry about it. I do like looking at that or considering that. Cash value collateral loans, on the other hand, those are much easier to deduct the interest, because that's leveraging a life insurance policy with a bank, often at a lower interest rate. And on the bank, we can check off that it's for business purposes if it's legitimately for business purposes. So we're going to look at some loans in actions here. In action, I should say. So dividends are applied to your full cash value, like we touched on earlier. Remember the example of real estate and a whole life insurance policy side by side? That 5% appreciation rate, the constant compounding on everything. So how that works is you continue to receive dividends on your full cash value as if you never touched it in the first place. How and why that works for the insurance company is, one, they do charge us interest, so there's a cost to borrow on the loaned amount, but then two, the death benefit's collateralized, typically dollar for dollar. As an example, let's assume that you've got $100,000 in cash value, and the death benefit on your life insurance policy is $500,000. You elect to take a $50,000 loan. There's a cost to borrow. That goes to the insurance company. What will your policy look like on paper if you go on your online account? You'll have $50,000 in remaining cash value, call it remaining equity if we want to use that illustration. But you'll also notice that your death benefit is now $450,000, not $500,000. So if you die with a loan outstanding, the net death benefit is the figure paid out to our beneficiaries. It's whatever the total death benefit is minus the outstanding loan. So what is the impact? Here's something I really like to look at, and I think that it's very important, is what's the impact on my life insurance policy if I'm going to use it for loans? I'm going to take a loan and I'm going to pay it back. What's it look like if I only pay the interest? What's it look like if I don't pay back anything? Seeing everything up front before I start a policy, and even after I start a policy through the ongoing service work, I love to model that out. This way, if I'm going to make a decision, I'm looking at a piece of property, I don't know how or when I'm going to pay it back. What are the different scenarios here? If I can see that, the actual numbers, to see what the potential drawbacks are, that's huge in my opinion. So let's look at some numbers. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.